Thanks everyone for coming back to our next edition of Econ Talks. Gareth, we've seen that bond rates are starting to rise quite rapidly. The 10-year bond now above its pre-COVID levels. The Reserve Bank's made it clear that there's not going to be any change from their point of view. They're not going to make any swift divergence from their current monetary policy track, but across the world we are seeing this feeling that there is more inflation coming, there's more interest rate rises to come sooner than possibly was thought. I mean, what's going on here?
Yeah, I think just increasing optimism as sort of vaccines start to get rolled out around the globe that, economic activity will gradually return to normal through 2021 or probably more likely out into 2022. One of the parts that goes along with faster economic growth is potentially more inflation as well, and I think that's one of the key determinants driving those bond rates up, is that markets betting well. We've had a massive amount of fiscal stimulus, we've had a massive amount of monetary stimulus, and surely those chickens have to come home to roost at some point in the future, and so that's primarily been driving the bond rate up. Now, what we've seen from central banks internationally, we've seen the Federal Reserve and the Reserve Bank of Australia saying, well, no, actually, we still think we need to stimulate the economy more, and they've been, upping their rates of bond purchases, but not something we've seen here. I know the Reserve Bank this week slightly increasing how much they were looking to be purchasing out there in the market, but overall, like you say, the reaction has been relatively muted so far, and I think they're kind of wanting to ride on the coattails a little bit of maybe some of that international purchasing by other central banks. I mean, where do we think that the central bank will go to from here in terms of New Zealand's policy?
Well, I think it is interesting because the Reserve Bank will be watching those higher bond rates with a little bit of concern, in a sense, because they will start pushing up, retail interest rates. That's not really what the bank wants to see. And in a sense, I think, you've seen that sort of response from RBNZ going, well, look, we'll lift our weekly LSAT purchases a touch, feeling that not only is there sort of those higher interest rates coming through on the 10-year bonds, but on bond rates, but also that feeling that maybe the market's not acting sort of in the normal sort of way that it would, needs a little bit of a helping hand, which is what the Reserve Bank started to provide a bit more support through in doing. But I think there's also probably a question there over if you do start to see these rates continue pushing higher and retail interest rates start to follow, that's going to undermine some of the monetary support. You do question whether or not the Reserve Bank will go, actually, we need to do something more about this. We need to really start to, put a bit more of a punch in. The feeling probably in a sense that the Reserve Bank's backed off a bit, a slightly more passive policy at the moment, given that stimulus has been front-loaded. The challenge, I guess, is that if the Reserve Bank was to up its LSAT program, how much more can it buy? At the moment, it has got a fairly full plate, and certainly, over the next, it's got a whole nother year for the LSAT to possibly run. It doesn't have a huge amount of extra bonds that are going to come on the market to buy. So I think the Reserve Bank's going to find itself a little bit limited there, but also willing, more than willing, that if things don't change soon, that they might go, actually, yep, we're going to hop into the market again. We're going to make a snap announcement. We're going to scare the market back into slightly more tame territory. Now, whether or not the market listens is going to be, I think, from my point of view, the big question. When we've had interest rates that were falling, when we've had the Reserve Bank saying, look, we need more monetary stimulus, everyone in the market listened. It was sort of, yeah, we totally get, things need to go down. The reverse is sort of happening now, and we have seen that on the upside, where the Reserve Bank's saying, no, hold on, nothing's really changing, and everyone's going, actually, no, we think things are going to go up. And that we have seen that even in pre-COVID times, when the bank was saying, look, we're not making much of a change now, we're probably going to need a bit more stimulus, and everyone in the market said, oh, no, everything's heading a little bit higher. So the Reserve Bank, in a sense, a little bit challenged and in a bit of a duel with the market over where things go next. What is that going to mean in terms of that monetary policy outlook from your point of view, Gareth?
Yeah, look, I think you're right that there's a limited scope in terms of those bond purchases to up that rate, because particularly given that government spending is not running as high, the debt levels are not running as high as would have been initially expected, under some of those scenarios we saw early on with COVID. It may be that they still have to look at other tools. They've got the funding for lending, for lending program that has been in place and has had a limited uptake so far. in terms of the banks drawing down on that money, whether there's a bit more push there to try and, keep the retail rates down by that mechanism. I don't know. I wouldn't expect the official cash rate to be cut, but it is also a question at the moment with the Reserve Bank. They're also coming under pressure in terms of the exchange rate. It's not just those bond rates, but we've seen the exchange rate pushing up. It was getting up towards 74, 75 cents against the US dollar. I know it's pared back a little bit since then. But again, that's just something of a constraint on the economy. It's coupled with higher commodity prices. We've seen those pushing up, and so exporters are still doing okay. But the Reserve Bank will be wary about some of those pressures coming through, and just, I guess, limiting or constraining the economy's recovery through the course of 2021. And to be honest, I think we still will be grappling with some quite difficult growth conditions through the course of this year. And if all we've got going for us is a booming housing market and the sort of affordability issues and crisis that sort of goes along with that, then the sort of balance to economic growth that we're looking at could be quite problematic. So yeah, some difficult issues for the Reserve Bank to grapple with there.
Absolutely, and I think that the big highlight from all of this is that interest rates are quite possibly at the lowest point they're going to be. It seems like unless you had a much more catastrophic economic outcome in recent times that would force interest rates lower, this is probably the lowest they're going to get. Maybe a little bit of quibbling around the 1 year fixed or similar, but the sort of trend I think now is for rates to start gradually rising. And so I think from people's investment point of view, this is the time that you're going to see investment come through, and the risk is that if you don't see as much investment coming through now, that could well not kneecap but certainly limit some of that pace of economic recovery that we're likely to see. Look, always fascinating to see where the interest rates are going. I think huge amounts of interest and intrigue out there amongst the community for where things head next. We'll continue to monitor all of these ones, and I'm sure Gareth will have another chat about this soon on one of the next editions of Econ Talks.